Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, October 29th, 2024 edition of Trading Places Live at earningsbeats.com. I am, really pleased to be with you this morning. Got the most bullish period of the year now underway. Started on October 28th. Of course, the worst week of the year ended on October 27th. So it's like literally turning the cold faucet on to hot from a bull's perspective, based on history. That doesn't guarantee us anything, but history does date back on the S&P 500 to 1950 in this case. That's how far I've gone back. And we are in the most bullish time of the year, which runs from October 28th through November 5th or 6th, depending on which index you're looking at. But it's also part of a much longer bullish period that stretches out from October 27th at the close to January 18th at the close, where the S&P 500 has gone up 63 of the last 74 years. So this is a historically bullish period. We'll see whether or not whether or not history prevails again. But for the most part, we do tend to see higher prices this time of year, and it is coinciding with the technicals looking pretty good. To be quite honest, I mean, we see most of our major indices set up in very bullish fashion, with price above 20-day moving averages, which is above the 50-day moving averages. And that's, the most bullish price outlook or look that you can get on the chart. So I'm feeling pretty good about the market. I know we're overbought. I know sentiment suggests that we could get a pullback, but sentiment, sometimes we can remain overbought for a period of time. As I say all this, futures are a little bit weaker this morning. The Dow Jones and the Russell 2000 both are down about 0.5% in pre-market action. S&P a little bit less. And last time I looked at the NASDAQ, the QQQ, which tracks the NASDAQ 100, that was relatively flat. This is a big, big week for earnings. Got a lot of the big names, many of the Mag 7 stocks reporting this week. We've got Alphabet or Google is going to be leading it off. We've got Microsoft, Apple, Meta, AMD, Amazon, a number of really big reports. These are companies that are market moving types of companies. These are heavily represented in the S&P 500 and the NASDAQ 100. And so as a result, what they do and how they react to their earnings is going to have a pretty big impact on how the market goes from here and how the market looks. I mean, if we get any kind of misses or warnings, we see breakdowns in price action or moving averages, that sort of thing, it could change the way the market looks here in the fourth quarter, despite the bullish historical outlook. So got a lot to think about, a lot to talk about. So let's jump in and get started here. First, I'm going to take a look at what happened yesterday. So again, we're starting the most bullish period of the year historically. And what did we do? Well, we mostly climbed. Dow Jones Industrial Average was up about 0.2%, gaining 273 points. S&P 500 up 15 points, back to 5823, still sitting just below the recent all-time highs, which are higher up into the 5800s, but still within about 1% of breakout territory. NASDAQ 100 flat and gaining ground, trying to reach that July all-time high, still coming up just a little bit short, but we'll see today. Today's a new day, and like I said, many of the stocks that are tremendously or highly represented in the NASDAQ 100 will be reporting this week. And this is going to be the NASDAQ's opportunity for a breakout to start this bullish period. Mid caps gaining more than 1% yesterday, up 31 points, back to 3138, climbing back above the 20-day moving average that I talked about earlier. Small caps doing the same thing. The IWM gaining 1.63% yesterday. So clearly, mid caps, small caps in favor to start this week. We'll see whether or not that continues. That's been fluctuating back and forth depending on the week. But at least for the start of this week, Russell 2000 gaining 1.63% to lead the major indices higher. Transportation stocks gaining more than 1%. So we did go down a little bit below the 20-day, tested the 50-day moving average. Now the transports appear to be rising. I would simply say Of all the major indices, if I had to point out two things that bother me a little bit right now, it would be the AD line on the IWM and the AD line on the transports, because they both clearly remain in downtrends with lower highs, lower lows, while the index is doing the opposite. Normally, I'd like to see, if the IWM was pulling back, I'd like to see the AD lines going up, showing accumulation during weakness. Where actually, if I'm being honest and objective, this is looking more like distribution during a period of rising prices, which is not what we want to see. Same goes for the transports. You can see clearly we are, over the last 3 months, putting in higher highs, higher lows, and yet AD line continues to go opposite. That's completely different than what we're seeing on the other major indices, where the mid caps broke out with a breaking out AD line. NASDAQ hasn't yet broken out, but its AD line is stronger. S&P broke out, strong AD line. And then we've got the Dow, which has been going up pretty consistently as well the last few months with a strengthening AD line. So it's not, I don't want to call the market bearishly because of two indices, but it's something to be aware of. For whatever reason, small caps, transportations do not appear, at least based on this indicator, as though they're being accumulated. Moving on, financials, beautiful uptrend in play, bouncing off the 20-day moving average. That was an area where we saw some strength yesterday, with the financials gaining 1.24%. AD line there strong. Materials, kind of a double top and double bottom. So I'm just seeing like sideways consolidation here. But I do think this 50-day moving average represents some pretty good price support as well. So I want to see that hold. We did bounce off of it on Monday. We'll see if we can continue that today. But materials gained 0.8% yesterday, again, with an AD line that is strengthening. Even energy on this last move to the upside, when it went up near 95, saw some strength in its AD line. It's pulled back a little bit, but not much, considering how weak the stock has been for about 2 or 3 weeks now. Energy, the XLE, dipping back below its 50-day moving average yesterday. Not very good action. Crude oil prices were dropping, but the AD line actually holding up fairly well. So can the energy group hang on? Well, we did rise back to 89.20. You can see we were down in the 87s. We closed at 89.20, so we got a hollow candle. And with that, we were able to hold on to that 50-day moving average, which is sitting down at 88.93. So even though yesterday was a rough day for energy, it was the worst performing group, we did see some strength after a weak open. And that maybe leaves the door open here for some more strength in energy coming off of that downtrend. As far as some of the key areas in the market, industry groups that performed well yesterday, renewable energy. This is a group that's pretty beaten down, broken down, recently moved to about a 6-month low, but is bouncing back. Got a 20-day test coming up. Can we get through that? That's going to be the first test there. But this configuration on the renewable energy group is really bearish, considering where almost every other group resides right now, which is mostly above 20-day or at least 50-day moving averages. But renewable energy, clearly one of the weakest areas. Is this a bottom? Are we getting ready to rally? We're going to find out. But at least in the short term, we have a slight uptrend starting to take place. The durable home goods, you can see right here. Starting back, triple bottom there at about 121, 122. You can see that beautiful uptrend that's in play. AD line was participating, but it has been pulling back as we've broken out. So I'm not sure whether or not this continues or not. It looks like we could probably use a little bit more confirmation. I wouldn't be surprised maybe to see a pullback to around that 150 level, and then we'll go from there. Nice to see the banks rally again. That was one of the reasons why financials did as well as they did yesterday. Asset managers also had a pretty good day yesterday. Many of the financial areas did perform well on Monday to open the week, but banks trying to make another breakout again. Be watching that closely to see if we can get that breakout. AD line continues to support this group to the upside. So that's just a quick update. Some of the areas I thought worth mentioning on Monday. 10-year Treasury yield getting an update here. This thing just keeps going up. 4.329. That's 4.33%. Here's the deal, because, we've kind of gotten into this, we've kind of gotten into this mindset with the 10-year Treasury yield that up is bad and down is good. And that is definitely the case when it comes to how interest rates are reacting to inflationary concerns. When rates are going up, it means the market's concerned about inflation. We've got investors wanting a higher yield to fight off inflation. I mean, if you've got inflation issues, you're going to want higher yields to offset that, or you're not going to invest in bonds. So investors require higher yields. It's different if inflation is to the wayside, and that's what the Fed has told us. That's what the Fed told us in September, was that they're no longer concerned about inflation. They feel like they've gotten inflation under control, and they were ready to start cutting rates, which they did. They cut them 50 basis points. That's not what you do when you think inflation's a problem. So I think the Fed has not only spoken about the fact that inflation has been beaten, but they've also taken action. So when I see the yields going up, some are still talking about inflation until I hear the Fed chief come out during one of these meetings saying, well, inflation's back on, and, we're going to no longer be dovish, and we need to watch and maybe have to raise rates again. Hey, if the Fed comes out and says something like that, I'll be concerned about inflation. I'm personally not concerned about it. What I think this is telling us is that the economy is simply stronger than any of us realized, even with rates being raised as rapidly as they were over 2 or 3 years. The economy remains resilient. Last month, we had jobs come out way above expectations. We've got jobs coming up again this Friday. I think there are a lot of folks selling bonds simply because they're worried about maybe another strong jobs report and maybe what that might do for the Fed. I don't think it's the strong jobs the Fed was fearing. I think it's inflation. That's what the Fed was fearing. So again, I think we still could have this nirvana situation where the economy is strengthening, but inflation is dropping and still giving the Fed the leeway to lower interest rates. I mean, if the Fed lowers while the economy is still strong or expected to strengthen, that's the other thing. It may not be that the economy is so strong. It may be that the market analysts and so forth are looking down the road and seeing a stronger economy or a strengthening economy. So when I look at the yield, one side of me says, well, this isn't good for the market, and it hasn't been good for the market. But yesterday I noticed with the yields going up, small caps did well, banks did well. And that's not been the case recently. So are market dynamics changing here a little bit? I mean, I think we have to stop and pause and at least ask that question. Because if longer term rates are going up and the Fed keeps lowering the short term rates, that is an environment where small caps and banks would do extremely well. Borrowing costs coming down and the economy potentially heating up, that would be, nirvana for that area. So it was just one day. And like I said, when I looked at the IWM and I looked at the transports, the AD lines aren't strong. There's definitely a mixed picture in the small cap and mid cap arena. But if you look back to where we were when that June CPI report came out in mid-July, small caps are still outperforming both the S&P 500 and the NASDAQ 100 by a pretty wide margin, and they added to it yesterday. So I'm, trying to objectively look at the charts to see what they're saying. And the problem I'm having is if interest rates were going up because of inflation, we would be seeing the growth stocks absolutely getting hammered to the downside on a relative basis. And yet, when I look at something like the IWF, IWD, and, this is where we bottomed back in August. Let's just get rid of the candlesticks. So here's where we bottomed, had a double bottom August and September, but growth is actually outperforming value during this, not by a lot, but it is outperforming. And inflation was a worry, I would think that this downtrend would simply be accelerating. That's not the case. We've got, QQQ versus the SPY, which bottomed in September and working its way back up. The XLY, XLY, XLP. Typed it in right. Look at August till now. Money is rotating more toward discretionary stocks and staples. Folks, if inflation was a problem, money doesn't go into discretionary stocks over staples. So the story that the charts are telling me is that inflation still is not the problem. That's not the way Wall Street is trading. It's not trading thinking that we're running back into an inflation problem. And I think that's really important to recognize in this. So why are rates going up if it's not inflation? The only thing left is the economy. I mean, that's the two factors that primarily drive rates. That's the only two factors that drive the Fed and the short-term rates. But those are the two primary factors in the long-term rates as well. So you can make what you want of it, but to me, it seems like maybe the fact that the rates are going up. Now, if the rates go up too far, we got problems. I mean, historically, we know from many, many years ago that rates, if they get up and they stay up above 5, and especially if they start creeping towards 6, at some point, investors are going to say, this could create problems in the stock market. And now CD rates are X, maybe they're up to 5.5%, 6%. And investors start making the decision to pull money out of the stocks and put it into fixed income. And that's the problem when rates start to get up too high. Right now, the question is, if you want to go get a CD, maybe some of them are around 4%, maybe you can get some a little bit higher. But is that enough of a return over a period of time where you wouldn't want to have money in stocks? I don't think so. But as rates keep moving up, that could become a problem. And that is what we have to watch for when rates go up. Moving on, S&P 500. Here's the chart. Here's your daily chart trending up above the 20-day, which is above the 50-day. That's that bullish configuration I'm talking about. If we pull up the weekly chart, we're above the 20-week moving average, which is above the 50-week moving average. Again, bullish configuration. Monthly chart, price above the 20-month, which is above the 50-month. Perfect perfect setup there. So I'm not seeing really much to get upset about here in terms of price action. And what's the number one indicator in the stock market? It's not divergences. It's not sentiment. It's not, trend lines. It's price action. It's price and volume. That's your number one indicator. Anyway, that's my number one indicator. You can have whatever number one indicator you want. But for me, it's about price. And so, back at the end of 2021, because I keep getting this question, well, are we setting up like 2021? No, we're not even close to 2021. We're starting to see a little bit more complacency in the options market. That's for sure. We've got that 5-day reading, which has been in the low 50s now for probably the last few weeks. We hadn't seen that in a long time. So yeah, things are changing as the market keeps going up. We are definitely seeing folks getting a little bit more bullish and complacent. We're seeing a lot of that pessimism and fear, deteriorate, which is a good thing. That's what keeps the bull market going. But we're nowhere near an extreme on a long-term chart where we've been bullish for so long that we can't go any higher. It's nothing like that. It's nothing like it was in 2021. It's like night and day, to be quite honest. But we are moving in that direction. Could we be at that, crossroads by the time January rolls around? Maybe. I don't know. We'll keep watching it. But yeah, if the stock market keeps going up, I would think that there would be more complacency that starts to build in the market. And we could get to a point maybe where we're gone too far, too fast. My guess is that, we probably don't stop until we're above 6,000, well above 6,000 probably, before we have to evaluate that sort of possibility. NASDAQ 100, here's your daily chart trending higher above the 20, above the 50. Not quite breaking out though, not the same as the S&P. So since July, we haven't seen that same type of behavior in the NASDAQ that we've seen in the S&P and in the Dow, where both of those have gone to all-time highs. NASDAQ 100 has not. But the price configuration, this chart still looks very bullish to me. And again, we'll go look at the weekly chart. Bullish. Monthly chart. Bullish. I don't really see anything to be upset about. Now, small caps have been a different animal. The IWM outperformed the S&P and the NASDAQ by a huge margin in 2020 and into 2021. Since that time, this group, IWM, has been a big underperformer to both the S&P 500 and the NASDAQ 100. But when I look at the daily chart here, I see pretty good action. We haven't made a breakout on an intraday basis, but we did make a breakout on a closing basis. Came back down a little bit below the 20-day moving average, turned back up. It looks like we're starting to turn back up, although we do, like I said, we have futures that are a little bit down. Let me give you an update on those, by the way. So right now we got the diamonds, which are down about 0.4%. The SPY, S&P 500, down about 0.2%. The QQQ tracking the NASDAQ 100 flat, and the IWM down about 0.6%. So right now we've got small caps that are the laggard. That takes us down to 221.18, and the 20-day is at 220.62. So based on where we're looking right now, we're going to open in 9 minutes. It looks like we're going to open above the 20-day, but back down close, probably, or closer to the lows from yesterday. So we'll see whether or not that area holds. But right now, at least in the short term, it looks like we've got a little bit of upside action here as we zero in. You can kind of see we're starting to move back to the upside. And yesterday was the first hollow candle that we've seen over the last 8 days. So the 7 prior days, we had filled candles, meaning that we were closing below the open on the IWM. So throughout the day, it didn't really give us a sense of accumulation. It gave us more of a sense of distribution, which is exactly what I talked about earlier in terms of the AD line. AD line, you can see rolling over during this period and not exactly performing great. So anyway, that's the IWM on the daily chart. Let's move it to a weekly chart. Trending up, looking pretty good. Monthly chart, trending up, looking pretty good. And this is the part I think that a lot of folks don't really understand about small caps, because they're consumed by recency bias. And recency bias is that over the last few years, small caps haven't done well. They've been underperforming the S&P, the NASDAQ 100, and that has just been an area where you don't want to have your money parked, right? Well, there have been plenty of other times over the last 12 years where we have seen leadership from small caps. And the biggest leadership was, like I said, during 2020 and into 2021. And then, of course, rates started going up, inflation became a problem, and small caps struggled more than the overall market. But we're looking for a major breakout here. 234 and change, 235 is the really big level on the IWM. Short term, getting through and closing above 225 was one step. I think now getting through that intra-day strength around our intraday tops, which I think we're right around 227, 228. That's going to be the next level. Get through that, then we battle 235. After that, all-time highs, blue skies ahead. So still got a little bit of work to do on the IWM, and perhaps that's why maybe there's still a lot of folks not really believing in it. But I do think if we get that breakout, it's going to be a different story for the small caps. We'll have to wait and see. Transports also trending up. Did get a breakout. You can see clearly taking out tops from the last 52 weeks. Pulled back, though, to that 20-day moving average, now starting to turn higher as well. And as I mentioned earlier, that AD line is a problem. But stretching this out, looking at a weekly chart, lots of sideways action for the last 3 or 4 years. Monthly chart, though, transports have an uptrend in play. If you look at this chart, long-term chart, objectively, you see an uptrend. You see a high back in 2021. You see maybe, at least on the monthly chart, close to equal highs, rising lows, ascending triangle. No matter what you call it, is definitely trending higher. We continue to remain above that rising 50-month moving average. We're above the rising 20-month moving average, and the 20 is above the 50. So even on the transports, which have been so weak, we still have bullish configuration long term. So what we need from this is a breakout like we saw in 2020, taking out 2 years worth of consolidation, or a breakout in 2017 after a pullback during 2015 and into early 2016. Here we've been going sideways for probably about 3 years now. We need that breakout. I think it's coming. All right, moving on. For those of you who are new to Earnings Beats, if you're new to the show, welcome. We certainly appreciate you tuning in. Hope you like our approach and the way we approach the market. I think we give you some things to think about. We try to make the show as educational as possible. Yes, I'm going to give you a lot of my opinions and what I think the market's going to do or what it has done, but I'm going to give you a lot of reasons for those thoughts and those beliefs and expectations as well. Anyway, if you do like our approach, first of all, you got a no-cost 30-day trial to our service, our paid service. That will require a credit card, but we'll let you know at the end of the 30 days that your trial is expiring. Don't want you to be charged if you don't want to have the service. But if you just want to learn more about us for now, scroll down and subscribe to our free Earnings Beats Digest newsletter. This is where we talk about a lot of different individual stocks, maybe earnings related, could be trading gaps, do a lot of that during earnings season. And many of our EB Digest articles are based on companies that are either reporting, have reported, maybe will be reporting in a few weeks, that sort of thing, looking at relative strength, looking at, just leadership, looking at that AD line, see if it's being accumulated, those types of things. But we also get into, price volume, trend lines, moving averages, sentiment. I mean, all kinds of different areas of the market, trying to help our community grow in terms of their education. And hopefully it leads to better trading results if you are a trader, maybe better investing results. Anyhow, make sure you go to earningsbeats.com, scroll down, check that out. We'd love to have you. Let's keep moving. We're almost time. We got 3 minutes to go before the market opens. Chart of the day for today, I just wanted to point out 3M because they came out with their earnings recently. And let me see if I can zero in here. We gapped up, broke out to a new high, new 52-week high, and then immediately sold off. And we've seen a number of stocks do this, by the way. I know McCormick was one that came out with really nice results, gapped up, had a big sell-off. There are plenty of others. A lot of times, if they have good results, though, and they get the gap up, after trending up, this is what's called a buy on rumor. So you get a lot of movement to the upside, with the rumor being that 3M is going to have a good report. And then they have a good report, you get a gap up, and then you get sell on the news. So you get buy on rumor, sell on news. Many times that sell on news is an opportunity. So here we pulled back to about the 125 level. I think probably turned a little bit early. I would be looking at maybe 118 and maybe 112 is the key support levels on 3M. Maybe we don't go down that far. Maybe this 124, 125 level is now establishing a new low. I think that'll be determined a little bit. Hold on one second. I think that's going to be determined a little bit by whether or not we can get through these moving averages, the 20-day and the 50-day. If we do, I think it starts to set up more like sideways consolidation. If we don't, let's say we go up to the 20-day and we reverse back down. If we come back down below that 125 level, that would certainly be a bearish development because it would be looking like a downtrend. And then you would have to look at these key price support levels. So that's the way I would break down this 3M chart. I think in the short term, it's kind of, neutral. But if we get back up above the 20-day moving average, I think that starts to turn this thing a little bit more bullishly. And then we would simply just have to kind of watch this sideways consolidation pan out. And then a breakout above 141 obviously would be very bullish. All right. Let's talk about a few stocks maybe that are reporting or have reported. So yesterday we had Waste Management coming in after the close and reporting. Stock is up just fractionally this morning, but it's been in this downtrend, so it has not been a great performer. It's also been a relatively weak performer versus its peers. Then we have Welltower. Market must have just opened here. So Welltower beat, by the way, Waste Management beat on its top line by 10 cents, 196 versus 186. Welltower beat 111 versus 104. Welltower, though, was one of the leaders in its industry group. And you can see the market liked the fact that they are a leader, liked the fact that they beat estimates, and we're getting a gap up on Welltower. CDNS, Cadence Design Technology. We had a beat there, 164 over 144. And we got a nice $24 gap up right now, 9.5% higher. Ford reported, and Ford down, of course. I mean, this is what Ford does. If you want to see one of the most absolute disgusting charts over the long term, all you got to do is pull up Ford. Let's go back 40 years. And let's see, where are we right now? We're at $10.43. Where were we 40 years ago? Probably about the same level, right about $10, $11, $9. I don't know. Not much in the way of capital appreciation, I would say, over the years. This is the reason why I would never own Ford. It just, even when it gets going and folks start talking bullishly about it, it somehow is on this axis where it just comes right back to $10. It seems like $10 is the magnet for Ford, and that's been going on for decades. They pay a nice dividend, so if you want the dividend, that's fine. Just don't expect your money to grow. Let's see. Last thing before we wrap up, I wanted to get into the earnings from this morning. Bear with me. I'll get a couple of these companies that reported this morning. Novartis, NVS. So they beat 206 versus $1.94. Stock is down, though. McDonald's, 323 versus 318. But we got that whole E. coli thing going on. Stock is up a little bit. I think it's probably just sitting here and consolidating before another drop. Maybe I'm wrong. Maybe McDonald's can overcome E. coli. It's overcome a lot of things over the years. Maybe this is just one more step, but it would, E. coli took down CMG, Chipotle, for a long time back in 2015, 2016. I mean, if you're a restaurant, I can't think of too many words or things worse than E. coli. So I'm not interested in investing in McDonald's at this point. And I'm not interested in stopping by their drive-thru either, by the way. Pfizer, PFE, huge beat here, $1.06 versus 64 cents. Stock gapped up, and now it's down for the day. Another stock that just simply can't seem to get out of its way. Let's see if there are any other. PayPal reported they have a beat, 120 versus 108. PayPal down, but I tell you what, this has been a pretty good stock. It's gap down with good results. Let me see if they beat on their revenues or if I can tell. They came up just slightly short on revenue, so that might be part of the problem. Those were strong earnings. This is a stock that's been doing well. If I had to place a bet on it here, I would bet it goes right back to its high. Again, that's not a trade I'm going to make. Let me be clear. But if I had to place a trade, it would be on the long side. I would think we'd rally back. All right. Anyway, that is it. Let's see what the market overall is doing before we wrap up today. We got the Dow down about 1/3%. S&P down about 0.3%. NASDAQ 100 down here, down 0.2%. Small caps down 1%. So small caps giving quite a bit back so far this morning. We'll see if that continues throughout the day. But at least to start off, small caps not having a very, very sound day. All right, that is it for me. I appreciate everybody tuning in. Again, be sure to give us a shot. Come over and check us out for a 30-day trial or sign up for the EB Digest. Either way, love to have you. Click the button below, like our video, subscribe to our channel, turn those notifications on so you'll be sure to be notified when we do these events. We do have events on the weekend, especially, that we don't have a set time for. So you do want to be, if you want to be notified when we do publish those videos, make sure that you are subscribed to our channel with your notifications turned on. Anyhow, we really appreciate you. Have a great rest of your week, everybody. Happy trading.